Thank you very much, Ryan, and welcome to our special presentation tonight, where we're going to discuss your investing preferences and your portfolio. Joining me tonight is Charles Rotblut, and Charles, I'm glad to see you well rested. I think you just finished up a wonderful half marathon sometime in the past month or so.
That's right, a couple of weeks ago. You know, everything's closed during a pandemic, so I needed to find something to keep me entertained.
How'd you do?
I did okay. Wasn't necessarily fast, but got it done. So glad to know my inner athlete has not gone away.
Do you have plans to expand the length of that marathon? Are you going to go full marathon now next year, Charles? Or what are you thinking?
I think I have to go full next year. I think absolutely.
Very good. Well, I'm looking forward to tracking you on Strava, and looking at your comments as far as the weather and the interesting people you come across as you jog.
Well, there's always somebody out, even at 6 a.m. in the morning.
What are you planning on going through as far as our webinar tonight, Charles?
Well, I'm going to talk about investing preferences, taking what your personal, really your preferences are for investing, walking people through the thought process of why they're important, and then giving people some examples about how you can actually use our screens and other tools on the website to take your preferences and actually create buy and sell rules for your own portfolio.
I'm guessing when the market becomes volatile like it's been recently, it's good to have these rules set up in advance, so you know in advance if you want to go ahead and find opportunities when the market presents itself with a little bit of a downturn, or sell off some of your more expensive stocks. I'm guessing you'll be covering some of those elements today.
I will, and I definitely think having rules makes it easier to deal with the day-to-day volatility in the market.
Well, I'm looking forward to your presentation. I don't want to take up too much time here. I'll slide back into the background. I'll be watching the questions that come across from our members, and I'll interrupt if I see a stream of questions that are questioning a slide or anything like that. And I'm looking forward to your polls as well. So thank you very much, Charles, and take it away.
Great, thanks, John. Hello, everybody. Welcome to, thanks for coming to our presentation. I'm gonna switch here, do a share screen, and then enlarge this. So that way we're actually seeing the whole screen. Okay. So now, as I said, we're gonna talk about investing preferences today. And before I start, this is all based on the individual investor's wealth building process. We used to call it the AAII way. That was our code name. Now its official name is the individual investor's wealth building process. And this really is a toolkit to empower you to build your own personalized investing plan, to give you a process to where you can actually identify who you are as an investor, why you're investing, what your risk tolerance is, and then how you're going to manage your portfolio. It really comes down to 5 key steps: defining your goals, picking an allocation, identifying your preferences, selecting investments, and then monitoring and adjusting. So reviewing your portfolio, changing your portfolio, maybe when some investments are violating sell rules, perhaps there's been a change in your life, or perhaps there's something else that would cause you to revise your goals or revise your tolerance for risk. And to help you go through the process, we've recently created what we're calling challenges. And you'll notice on the slide in the very up top corner, you'll see where Learn and Plan is squared off in green. This is a new section on the website. We recently unveiled several enhancements to the website. One of them was this new Learn and Plan page. And on it, you'll find these wealth building challenges. Every one of those green bars you see on this page has a short video, short narrative, and one of the worksheets that form the toolkit that is the wealth building process. So I encourage you to take advantage of it, try out the worksheets, and give us your feedback. But today I want to focus on one of the key steps, and that's identifying your preferences. How are you going to invest? What's going to go in your portfolio? And the reason why it's important to identify your preferences is that you may have things that are unique to you. And it also gives you the ability to say no. So when you're watching CNBC and you're seeing some pundit talk about how great stock X, Y, and Z is, or how great it is to use this short-term tactical strategy, if you know, for instance, your preferences call for you to hold funds for the long term, it empowers you to say, well, that's interesting, but it's not really right for me. And it also narrows the field of investment. So if you go in and you say, well, I'm not really sure what my preferences are, then all of a sudden you're sitting at the buffet not really knowing what you have an appetite for. But if you identify your preferences, instead of going to the buffet, you might say, you know what, today I'm really in the mood for Chinese food. I'm really craving hamburgers. And so it's the same thing with investing. If you know what your preferences are, you can narrow down the scope, and it actually makes making decisions as to what you'll buy and even what you sell a lot easier. But it's important to realize these preferences vary by person. There's no one single strategy or preference that works for every person. I like to reference the Kinks song, I'm Not Like Everybody Else. Your preferences are what your preferences are. Some people really like getting very active strategies. Other people really like index strategies and really don't want to have to put a lot of effort into managing their portfolios. You might be a mix of them. It doesn't matter what they are, they're your preferences, but realize that some of your investing preferences might have been set very early in life, long before you were even thinking about the markets, perhaps during a time where your portfolio consisted of a piggy bank with coins in it. There's one study that suggests that our preferences for growth or value are partially ingrained at birth, and that other preferences are actually formed during our childhood, depending on whether or not we grew up in a very affluent household, we grew up in a household where perhaps there was struggles to keep food on the table. Those, whether you grew up in a depression or you grew up in an economic boom time, all those factors can actually influence how you invest now and the type of investor you are. So it's really important to acknowledge who you are and where you're at, and be comfortable with that and orient your strategy towards that, because your neighbor, your friend, they might have a very different personality when it comes to investing, and you both can be right. But the thing is, you're being right for yourself and not right for somebody else. But you also want to think about what restrictions or limitations do you have. So for tomorrow, for an investor update, I'm actually writing about how I invest. And one of the things I'm pointing out is that I do hold index funds, because at AAII, our 403B plan, which is similar to our 401k, is run through Vanguard. So because my retirement plans run through Vanguard, I'm going to invest in mutual funds. And many of you who are still working or are invested in a 401k, you can think of yourself as being a very active investor, one who loves investigating stocks, but you have this limitation that requires you to hold mutual funds. So that has to be part of your preferences when you think about your portfolio construction. By design, you're required to hold funds. But you also want to think about what your available time is to research investments, and also your interest. If you find looking at cash flow statements or reading through earnings reports to be absolutely boring, that's fine. If you love going through the 10K and trying to figure out where the red flags are in a company, that's great too. Just acknowledge these are your preferences and this is the amount of time you have, because that will govern your buy and sell rules. And if you're married or you have a significant other, I would consider what their comfort level is with what you're doing. You might be willing to take much more risk than they are actually comfortable with you doing. So you want to find that happy medium. And you also just want to consider your knowledge of investing. Realize what you know, realize where the boundaries are, and realize if there's boundaries you want to cross, you can pass those boundaries. We at AAII, obviously our goal is to educate you, to empower you. You can certainly go through our archives of over 40 years to find articles on various topics to expand your knowledge. But just be conscious of where your level is, of your level and your barriers of knowledge are. And realize when it comes to looking at particular investments, say biotechs or maybe technology, realize at the industry level, there may be also limitations to what you know and what you don't know. And build that into your rules. And most importantly, when you're thinking about a strategy and someone's saying how great a strategy it is, and look at these returns, stop and ask yourself, is this the right strategy for me? If that strategy is asking you to do things that you're not really comfortable with, if it doesn't really match your personality, doesn't match your time, your interest, don't do it. The worst thing you can do as an investor is try to force a square peg into a round hole. If the strategy isn't right for you, then it's not a good strategy for you. It's not a strategy you're going to stick with over the long term. So you really want to be clear about what you're comfortable with doing, what you're willing to do, and what you're not willing to do, and orientate your portfolio around it. Now realize that if you're going to invest for the long term and your goal is to grow wealth, you are going to have to be comfortable with being uncomfortable. We are going to have days like today where the market drops, and it's never fun seeing the market drop. So you have to be comfortable with volatility, but how you manage your portfolio, meaning how active you are, whether you favor growth stocks, you favor value stocks, you take comfort in owning funds, or perhaps having an advisor you can call up when you're nervous. Realize what those preferences are and build your strategy around it. So again, this whole idea of the wealth building process is to create a wealth building plan that's customized for your needs, for your preferences. And it may be a different plan than somebody else, even though they use the same toolkit as you did. But I also want you to think, for those of you who are retired, think about simplifying your portfolio as you get older. The reason why is, for many people, cognitive decline starts kicking in. And even at mild levels of cognitive impairment, we start having difficulty with managing financial statements, paying bills, and making financial judgment. And by the time we have mild levels of Alzheimer's disease, we've pretty much lost all our financial skills. And I've shown this chart in other presentations. And what I always point out to people, that what ought to really scare you about this chart is that this is not from any financial publication. This is from the Journal of the American Medical Association. One of the earliest signs of cognitive impairment is the inability to properly manage one's finances. So if you're retired and you're thinking about your preferences, you may want to think about making your strategy less complicated, particularly as you get older, because you're more apt to make mistakes. And in November Journal, which we'll have online next month, and I think my editorial department actually put this article online right now, a group of researchers looked at a study, a long-running study of retirees, to see what effect cognitive impairment had on their ability to manage their finances. And what they found out was that people who are aware that they had some cognitive impairment lost in stocks about $2,000. People who are unaware of their cognitive impairment lost on average about $12,000. Now, they didn't give the time frame of those losses, but they looked at waves, meaning the survey that this study is based on is conducted every 2 years. And they looked at multiple years, and they figured out this was the average. And what they found out was that many of these people had cognitive impairment. They weren't conscious of it, but they were active investors. And so they weren't realizing that their financial judgment had gone down. And in fact, it's very possible they were overconfident in their abilities. Now, this is not to say that every person is going to experience cognitive impairment, or necessarily that as soon as you turn 65 or 70, your ability to make good financial judgments is going to go away. But it does point out that it is a real risk. And as you're designing your wealth building plan, you do want to take the possibility of it into account and consider again about perhaps getting a little bit more simpler with your decisions, and perhaps setting up a strategy that requires fewer decisions than more decisions. Now, we've been talking about preferences, and in creating the wealth building process, one of the things we wanted to help investors do is just kind of describe what type of investor they are. And we gave some thought, because there's a lot of different ways we could have gone with this. And we really settled on trying to have some broad categories that describe a lot of investors. And so the categories we came up with, one was being fully hands-on. You love to handpick your stocks or perhaps even handpick your bonds. You love to roll up your sleeves, get into the financials, get into the earnings announcements. If you're in a technical analysis, analyzing the charts, you're a do-it-yourselfer. Now, some of you might be a partially hands-on investor, meaning you love all the stuff of being a fully hands-on investor, but you also use mutual funds, ETFs, maybe closed-end funds. A good example is someone who loves looking at stocks, but doesn't really want to get too involved in bonds, so perhaps they own a bond fund. Or again, using the example I gave earlier, perhaps you're employed and you have a 401k plan without a brokerage window, which means you're forced to own mutual funds, even though at heart you're a do-it-yourself investor. Now, the index investors, these are the Jack Bogle type investors. Take a lot of comfort in owning broad market indexes. And again, even though we have a lot of active strategies, our level 3 approach is a very passive index-oriented approach. So this type of investor loves to hold either index mutual funds or index ETFs. The fund investor is similar to the index investor, but they like active management. They want to have an active manager running their fund. Finally is a combo hands-on advisor. This person likes to make a lot of their decisions, but still works with a financial planner. And we know from our surveys about 30% of AAII members do work with an advisor or work with a planner. But a lot of people who work with advisors still make their own decisions. And that's fine. And the great thing about the wealth building process is you can walk through it, identify your preferences, and then if you do work with a planner or advisor, saying, here's how I figured out what my wealth plan should be. How are you implementing it? And if it's different than this, why? So it gives you the ability to actually have that conversation. So, and again, you might find yourself kind of in between, and that's fine. But the idea is we're trying to generalize because we think having these classifications will help you think about your preferences and again, help you design better rules for your portfolio. Now, I do want to give you the chance to actually tell us where you found these categories. Ryan, do you want to show them the poll?
Absolutely. So we'll go ahead and poll the audience. What type of investor do you most identify with, as Charles just laid them out? Please select from yourself as a fully hands-on investor, a partially hands-on investor, an index investor, a fund investor, or a combo hands-on advisor type of investor. We'll leave this poll running for a little bit while the responses come in, and then we will share the results afterwards. John, do we have any questions that may have come in that we can kind of go over?
Sure. Not too many here, but Charles, a couple questions. First of all, if someone wants to gain access to all of these resources you're talking about here, what's the best place to go? Is it the Plan and Learn and Plan tab on the homepage of AAII.com?
You know, I think the Learn and Plan page is a great place to start because we do have the videos introducing each section. If someone wants to see everything we've built up, the other alternative is they can go to aai.com/AAII. They'll see everything we've created, all the commentaries we've created for the wealth building process. So the Learn Plan kind of gives them a very short multimedia experience. If you go to the AAII web page, you get everything we've done, all the commentaries. So both are very good resources.
Okay, very good. And we're recording the webinar, and tomorrow we'll send out a email, and we'll include a link then to the resources that Charles is talking about.
Absolutely.
And one more question here, and it's it's a member who's wondering what he should be doing as far as the his bond portfolio, and he's anticipating bonds staying steady for a couple of years. Does that mean interest rates? Does that mean you should go long term, or what are your thoughts as far as that kind of process?
Sure. There's a couple schools of thought on that, and it does depend also what you're holding. If you're holding individual bonds, or you're holding defined maturity bond funds, which are funds that do mature on a certain date. You could, if you want to go long, you could ladder your bonds, which means you're holding bonds or defined maturity bond funds with different maturity dates so that they mature at different times. That takes a timing risk out of it. Certainly, if you're holding a bond to maturity, you would lock in the interest rate for a longer period of time by holding a bond. The argument for holding intermediate term bonds is that you're getting close to the same yield. You still have a small cut, but you're taking less interest rate risk on it. So I've seen people argue for both. When you start getting the very short end, you start looking at those yields are so low, it's really hard to argue having those versus saying perhaps a CD. I personally, so it's, whatever you're comfortable with. We have arguments for both, but I do think if you're holding bond funds, realize that they will react to the changes of interest rates, and eventually they should catch up, but there will be a period of time where you don't have control over what's going on. The portfolio manager himself of the bond fund is making his decisions about how to orient the portfolio relative to interest rates.
So I just wanted to share the results of the poll with about 90% of the audience tuning in. The greatest answer was 43% find themselves a partially hands-on investor, followed by the combo hands-on advisor type of investor. They're 26%.
Oh, that's great, Ryan. Thank you.
Charles, when it comes to finding an advisor, a member here has a question, maybe just clarification. So where do you find an advisor that you can work with together on the actual stock choices? Most of the advisors that he's come across do not ask you for your advice.
Sure, there's a couple of things you can look at. One, the CFP board, and we'll put the links in the show notes at CFP, I want to say .net. They actually have where you can find a planner on their website, find a planner link where you can actually talk with them. There's also the National Association of Fee-Only Planners. We can certainly put a link to that on our show notes as well. These are planners that, as the name implies, are fee-only planners. They don't work on commissions. Those are two really good sources to actually start looking. On our website, we ran an article in a journal a few years ago with really, I think it was 5 key questions to ask a prospective advisor or planner. I'll certainly give it to Jean, our editor. She's putting together show notes. We'll have that as well, so you can 5 good questions on what to ask a planner. And this was actually written by an advisor with many years in the field to help you kind of judge the planner. One thing I would say though is whenever you're considering hiring an advisor or a planner, check with your state regulators, check with the SEC, but also I think it's good, just put their name in a search engine like Google and just see what comes up to see if there's anything that should give you cause for worry. There shouldn't be, but for a little bit of effort, it could save you a lot of potential headaches down the road should you have that one person who may not be on the level as we would like them to be.
And one more question, I guess, before we go ahead and continue on. Would you consider AAII to be an advisor? This person doesn't because we don't provide specific individual advice.
No, we're not an advisor because we're actually a nonprofit organization, and because of our nonprofit status, not only can we not give out advice, but we also are not allowed to manage anybody's money. We manage the association's money. So for instance, the shadow stock or stock superstars, that's actually association money and real money portfolios, but we cannot give out personalized advice. Even though I'm a CFA, I'll point out that I do not hold any security licenses either. So I couldn't actually sell you investments without violating regulations and even violating the ethical code of the CFA Institute.
Very good. Well, thank you, Charles. I'll let you continue on with your presentation, and I'll be back here watching for questions to respond to, for you to respond to later on.
Great. Thank you, John. Thanks, everybody, for participating in the poll. So it's interesting, a lot of people did say use a blend because I did the strategy today to actually talk about both stocks and funds. So we're going to get to both, which is good. So I hit it right. But first of all, I want to talk about implementing your preferences into a portfolio, particularly if you know what kind of investor you are, you know what your preferences are, how are you going to develop buy and sell rules? So we're going to actually use a value-oriented strategy today to kind of give you show you how you can do this using the tools on AAII.com. But in general, regardless of your value, your growth, or use funds, there's some just general rules for investing that underlie any successful strategy. The most basic, if you wanted me to just give you the down and dirty, cut right to the chase, is to sell an investment whenever it no longer meets the reasons you bought it. That is as simple as a rule. That really underlies all strategies. And so it's really important to understand, why did you buy an investment, and know what your exit plan is going to be before you bought it. So perhaps someone gives you a tip and saying, hey, this stock's really going to take off. They get this cure coming out. It's going to get approved by FDA. It's going to go gangbusters. You go buy it, and all of a sudden it flops. It doesn't get FDA approval. You want to make sure you get written down, if this does not pass FDA muster, I'm going to get out of this stock. And a lot of people often do is they jump on a hot tip, but they don't think about what their exit plan is. So it's always good to have an exit plan before you get involved. But you also want a strategy that's going to be systematic and repeatable. So going back to our founder, Jim Clunan, one of his 2 rules for investing success was have a developed, well-defined approach to investing, and always remember that rule. So it really comes down to having an approach that you follow every time, that's rules-based and that you can keep repeating time after time. It should also be simple enough that you're able to follow. Now, what counts as simple enough? Well, again, that varies by person, and this gets to your preferences. Some people have some very complex strategies that they are very at ease doing, and other people look at those rules, see all the steps involved, throw up their hands in the air and say, there's no way I can follow it. So this varies by person. And what's simple for one person may be complicated for somebody else, and that's okay. Just know who you are and where you're at as an investor. You obviously want to be cost effective, but also think about how much time you're willing to devote to the strategy. If it's going to take too much time and effort, you're probably not going to stick with it. So always consider that as well. And now, if you're wondering, we actually get asked a lot, well, can you give me some tips on buy and sell strategies? In fact, we have 60 strategies you can look at for ideas. If you go on your website, we recently redid our navigation. You'll notice in the green box where it says screening. So we actually separated our screening into its own section on the website so you can find it. You'll notice to the left of it, it says investing ideas. So this is investing ideas. You'll find things like our mutual fund tools or ETF tools. You'll find our stock grades. Under screening, you'll find our 60 stock screens. And obviously on the right side is the learn and plan page, which I talked about before. But I'm going to actually focus on a particular screen, the Buffett Hackstorm screen. This is based on my Robert Hackstorm. I just happen to have his book right here, The Essential Buffett, put off my bookshelf right before we got started. But this is one of our better performing value screens. And I'm pointing this out not to say this is the one screen you should follow, but it's a pretty simple screen. It provides a good example of how, if you don't have some buy and sell rules, but you want to develop them, you can go through our 60 stock screens, and we will tell you which ones are growth oriented, which are value oriented, which say are momentum oriented. So you can actually find screens right off the bat that match the style of investing you want to use. And on any of these screens, you'll notice in the second green box, I have highlighted learn how to do it. So any of our screens, if you click on the headline, click on the name of any of our screens, as I said, we have the Hackstorm screen right here, and you see learn how to do it. If you click on that, they'll scroll down the page and actually give you the philosophy behind the screen. If it's a guru screen, explain the guru's approach. If it's a factor screen, explain what the factor is trying to look for, and then it will give you the rules for the screen. So I actually summarize the rules here for the Hackstorm screen on this page, because if I did a screenshot, it would have been a little too small for you all to have seen. But let's look at the rules for what the screen does. So he's looking for larger stocks, market caps of 1 billion or more, so large cap, mid cap stocks. So right off the bat, we know this is a screen that's looking for larger stocks. He wants companies that are profitable. He also wants them to have good margins. So he's looking for ROE, return on equity, to be above 15% over the last 3 years. So he's not only looking for companies that are profitable, but have good profit margins. He wants them to have lower than average levels of debt for their industry. It's important, and also the same with his operating margin and net profit margin. Now, I will point out when you look at your rules, you will see people looking at margins. You will see strategy looking at levels of debt. Realize both margins and debt are particular to a given industry in a particular sector. Some industries, when we talk about manufacturing, for instance, are very capital intensive. Caterpillar, they reported earlier today, so they're front of mind. Heavy equipment, need a lot of inventory, need a lot of, obviously a lot of machinery to make the machines. So they're going to be more capital intensive than say a biotech company or say a Microsoft. So that's why when you look at things like debt to equity or operating margins, you do want to consider the industry a company's operating in. Now, in this case, Hackstorm also wants the price return to be greater than book value. What he's looking for is a price that's rising faster than a company's assets. So he's looking for companies that aren't actually getting bloated on their balance sheets, because when a company has a lot of asset growth, but you don't see a lot of price movement, it might be that the assets it's adding to its balance sheet may not be productive in terms of generating future revenues and earnings for the company. Finally, because he is a value investor, he's looking for a low price of free cash flow. Again, this is a Buffett type strategy, and Buffett obviously likes companies with good margins, moats as they like to call them, that are also profitable, but also trading at good valuations. Now, let's say you hadn't read Hackstorm's book, you've heard a little about Buffett, but you don't know a lot about them. And you're looking at the screen here, you're saying, that's great, I'm seeing all of this, but I don't exactly want to place all these rules. I want to have my own strategy. So how do I take this and implement it into my own portfolio strategy? Well, stop and ask yourself, what do we know from looking at the screen? Well, we know, even if we never read Robert's book, even if we didn't know much about Buffett's strategies, we know just by looking at the screen criteria that companies must be profitable, that they have above average profitability, below average debt, good return equity, good price performance, and low valuation. So even if you knew nothing from the screen and you were looking for suggestions on how to build your strategy, if you look at the screen, which by the way does have good long-term returns, you could say, well, maybe my strategy ought to look for profitable companies. Maybe I ought to consider having some type of criteria for profit margins. Maybe I ought to consider valuations. So again, even if you knew nothing about the group, you can look at what they're doing and create general concepts for your portfolio that will serve as the basis for your strategy. Now, I happen to just pick Hackstorm. You can do the same exercise with any of our other strategies where you're looking what the criteria is. I'll go back here, asking yourself, okay, if I'm looking at this criteria, what can I tell from just looking at it? And then what should I form to be the basis of my strategy? And you could easily, say if you're a growth investor, look at several growth screens to try and build a consensus or try to build some ideas where you then personalize it for your own strategy. You could also, of course, simply decide, you know what? I like this strategy. I'm going to follow the screen and I'm going to use it for investing ideas. That is another strategy that works well as also. And again, it just depends on your investing preferences. Now, keep in mind that screens are essentially filters. They're looking at the whole universe of stocks and screening for companies that meet the specific criteria. So I'm going to go back here again. So in this case, the screen is looking at all the criteria for the screen and taking each stock and saying, does it match to everyone's criteria? The answer is yes, and it shows up on the screen results. The answer is no, it doesn't pass the screen. So you could have a stock that's passing a screen, and all of a sudden, one day it no longer passes the screen. Say, for instance, a tough day like today, and the stock's market cap dropped from, say, 1.02 billion to $998 million. Now, we know in terms of market cap, that's really not a big difference. But to the screen, it's setting the line in the sand at $1 billion. So suddenly that stock's no longer going to pass the screen. Doesn't mean it's no longer a bad stock. It just means that one criteria is no longer passing the screen. So when you're using these screens, realize a stock may no longer pass the screen, but it doesn't necessarily mean it's a bad stock or it's automatically a sell. It just means that at least one of the criteria no longer matches the screen. And again, these are filters. These screens are not managed portfolios. Our shadow stock portfolio, our VMQ stocks, our stock superstars, our AAII dividend investing portfolios, those are actual portfolios we at the association run through a brokerage account. So we are actually buying and selling stocks. The screens you see on AAII.com, which you see under screening, these are these database filters where they're just it's really the computer taking these filters and screening through the universe, looking through for stocks. So if a stock's passing the screen, also it doesn't start passing, also it stops passing the screen, you may want to ask yourself, okay, what's going on? What criteria do I need to check? You can do this on AAII.com. So Tractor Supply is a stock that actually happened to be passing the Hackstorm screen over the weekend. And this is our stock evaluator page. You can get to this page by going anywhere on the website. In the very top of our website, you'll see a search box. You can type in the ticker's name or the company or the fund's name or the ETF's name, and you'll get the evaluator page. So this is the evaluator page for Tractor Supply. As an AAII member, you'll actually get fundamental data on the stock. You'll get information about the market cap. You can see how it compares to other companies with its industry. And there's a lot more information if you scroll down this page. I wanted to at least keep the page at its size. You can actually see what's going on. But you can go to AAII.com right now, or hopefully after the presentation, and find this information. And I'll show you later. We have similar pages for mutual funds and ETFs. Now, if you're an A+ investor page, you get access to more tabs, such as access to our grades, access to what analysts are doing, access to several years of valuation data. But even if you're not an A+ investor, our evaluator has a lot of key information you can use to determine whether or not a stock is still meeting the fundamental criteria you're looking for, as well as some of the price data you're interested in. So when you're using these screens, all of a sudden the stock falls off, or perhaps you're trying to build a sell strategy based on the Hackstorm screen. What do? And well, again, that golden rule of sell when the opposite occurs. Sell when the reason for buying the stock no longer applies. So how do you do this? Well, the company's no longer profitable. In this case, we know Hackstorm was looking for profitable companies. Well, if suddenly it starts losing money, that would be a reason to sell it. If you see margins deteriorate, all of a sudden it's underperforming its peers, not beating its peers. Again, violating a buy rule. If you see debt suddenly take a big rise, and then keep in mind when you look at debt, you want to ask, why is debt rising? If debt's rising because the company's struggling, that may be a bad sign. But the company's issuing bonds because it's planning on building a new plant, a new facility, or to drive expansion. In that case, the increase in debt might actually be justified. So you do want to consider, why are they raising debt and what's the rationale for it? And is the reason for raising debt possibly going to be beneficial over the long term? And of course, in this case, since it's looking for valuation, in this case, Hackstorm was looking at the price of free cash flow ratio. So if suddenly the stock becomes very expensive because the ratio becomes high, or in this case, if the ratio becomes NA, meaning all of a sudden the company no longer has free cash flow. That might be a reason to sell the stock. Now, I will point out with a free cash flow ratio, it could be to a one-time decision. Maybe they decide to build up a lot of inventory because they're realizing inventory is hard to get, say because of the coronavirus. Maybe they're spending a lot for a lot of expansion. So you do want to take a look at why that free cash flow ratio is negative. But say if it's book value or it's a PE ratio, if that says NA, it probably means those ratios went negative. So you do want to investigate why. But the general rule is you can look at a screen, and even if you know nothing about the guru behind the screen, or you're not familiar with all the strategies that a factor screen is based on, you can still look at the screen, make some judgments about what it's doing, and then build your sell rules to be the opposite. So you could, again, follow the screen, or you could use it as the basis for building your own buy and sell rules. And with 60 stock screens, you actually have a big sample to actually choose from, so you're not locked into one single screen. And again, we do label them by growth, by value, by quality. So if you're looking to create your own rules or get some guidance on how you should build your rules, you could actually get a consensus or get an idea of what multiple screens are looking at. Now, I want to stop for a second. Ryan, I believe you have another poll, correct?
I do. We'll go ahead and launch that. We now that Charles has kind of gone over some sell reasons why you might want to sell a stock, we were curious what you would do, what your top reason is for selling a stock. Your options are valuation, price performance, change in fundamentals or dividend, perhaps you found a better stock, or if the stock in your portfolio had disappointing earnings or business performance. Please select an answer for one of these, and we will share the results momentarily. John, any questions that came in that we can talk about?
Sure, definitely. So Charles, a couple of questions that just want some additional information as far as fee-based planners versus planners, advisors that charge a percentage of AUM. Again, there's a big difference there, and what would you recommend as far as considerations there?
So people are charging on a basis of AUM. They're generally managing your investments in that scenario. So they're actually helping you pick your investments and manage it. Where fee-based tend to be more fee plans, where they're giving you guidance and more telling you what to do. So it's a big difference between the two. I have a friend of mine who's a planner. He does some fee-based stuff. He also does percentage of AUM. He's licensed to do both. It really comes down to what you're doing. And for a lot of people, they may be working for an advisor. What they really need is just a planner, someone to bounce ideas off, someone to just talk to and say, am I on the right plan? Can you refer me to certain other professionals? So part of it really comes down to, are you looking for guidance as to your overall plan, or are you looking for someone to help actually pick the actual investments? And I think it's a key thing for a lot of people. What they're really looking for is just someone to try to give them more guidance in terms of how they should be managing their portfolios as opposed to actual investment advice. So that's the difference. That's really the thought as to what exactly do you need. And for a lot of people, it may be that you just need a planner and not necessarily an advisor. But certainly, if you want someone helping you manage your investments, then in that case, you'd be leaning more towards a fee-based person that's charging a percent of assets that they're overseeing.
And as a follow-up to that, the question here, how do robo-investors fall into the spectrum?
So robo-advisors, that's a growing field. So robo-advisors, they're making the investment decisions for you. We have a few articles we've done on them, on robo-advisors, but you're basically investing with them and they're making the investment decisions for you. So most robo-advisors will have you take a risk tolerance quiz, try to assess your goals, and then they'll use their mathematical formulas to determine how your portfolio should be managed. Some robo-advisors do actually have a human advisor you can talk to. The services do vary, but the idea is versus having someone make the decisions about where your portfolio should be invested in, it's actually relying on the computer and on their formulas to determine how your portfolio should be managed.
So while we kind of go over some more questions, just want to go over the results of the poll with about poll being open for about 3 minutes. 78% of the attendees tonight voted, and roughly neck and neck between disappointing earnings or business performance as a top reason for selling a stock, and change in fundamentals or dividend coming in at 28%. Does that surprise you at all, Charles?
No, it doesn't. I wasn't sure what people would say. I did figure earnings are bad, business fundamentals would actually probably be near the top of the list.
I also wanted to note that somebody noted in the questions panel here that one of the options that wasn't available was did not include harvesting losses, which they define as based on market volatility or being overbought.
You know, it's certainly, if you're in a taxable account, that can certainly be a strategy. Well, I'll just say real quick about harvesting losses, is that there's a 30-day wash sale rule. So if you sell a stock at a loss, you cannot buy a substantially identical investment within a 30-day period. Now, what's interesting is when you look at mutual funds and ETFs, right now the general consensus is the IRS treats ETFs from different fund families as being different. So technically, you could take a loss in a Vanguard S&P 500 fund and turn around and say buy the S&P Spiders ETF within a 30-day period and not violate the wash rule. I do think you're really pushing the limits there. But what you could actually do is sell a S&P 500 fund, buy a total market fund, and even though they're very close, under the wash sale rules as they currently are, and I do want to stress as they currently are, you're not violating the wash sale rules. But you couldn't sell, say, your shares of Microsoft and turn around and buy calls in Microsoft, or turn around and buy Microsoft, sell Microsoft in your taxable account and then go buy in your IRA. That would be a violation of the wash sale rules. So if you're going to harvest tax losses, be aware of those rules at play.
John, did you want to chime in with any other questions before Charles continues on with his presentation?
Sure. You know, since broker commissions have been eliminated, has that changed any of your approaches towards buying and selling stocks? One member here notes that he's been doing more dollar cost averaging now.
Yeah, it has. And actually, tomorrow's investor update, I was talking about how I have money coming from my paycheck and how that get automatically diverted to my accounts every paycheck. It definitely helps, I think, people with smaller amounts to say, if you're putting money into a Roth IRA or you're putting money into a traditional IRA, even if you're able to put in the maximum amount, which is $6,000 or with $1,000 catch up if you're over age 50 or over, if you're doing it every pay period, you're talking about $250, $300 every pay period, which is a very small amount. But now with commissions being at zero, you could actually buy ETFs, or if there's a stock you want to accumulate a position in, you could actually do that in small dollar amounts. So it definitely helps a lot of investors to take advantage of dollar cost averaging in a manner which they couldn't before, because even when commissions were at $5 or $10, if you're looking at putting in small dollar amounts, $300, $500 at a time, it was very hard to build those decisions. So I do think it opens up a wider universe of investments to individual investors.
You know, when it comes to criteria, buy and sell criteria, you know, one member was a little bit frustrated with sometimes, you know, how a stock may go from being a buy to a sell because of a short-term incidental reason for no longer passing a screen. How do you handle that kind of, you know, whipsawing action on individual stocks when dealing with quantitative screens?
Sure, and that's the thing where if that concerns you, you may want to build in some margin for error. To give you an example, in our shadow stock portfolio, we obviously look for profitable companies. But if a company has a bad quarter, that puts on an earnings probation, and then we wait another quarter to see if earnings are staying negative. So in that case, we give the company some buffer room, but not too much. And, you know, if you're looking at more in terms of price momentum, in our VMQ stocks portfolio, whenever we add stocks, we have an initial 6-month probationary period. So if we buy a stock and something happens, all of a sudden it loses its strong momentum, we're not having excess turnover, but we're not letting things go too far. So if you're worried about that type of volatility, you could actually incorporate in your sell rules some type of buffer, be it momentum, be it if it's fundamentals, be it if it's valuation, where you give yourself a certain period of time. Maybe it's a quarter, maybe it's, like we said, a 6-month initial period to see if things turn around. The idea, though, if you do that, you have that boundary. If that boundary is crossed, at that point, you will act.
Very basic question here, but if a member knows a company but is not familiar with their ticker symbol, what's the best way to find out the ticker symbol or trading symbol?
One of the things you can do actually on AAII.com, I'll give a plug for our website. If you go to the search bar, if you just type in the name of the company, it will actually give you the ticker symbol. The other thing I will point out, though, if you know the name of the company and you want to learn more about it, type in that company name into a search engine and type in investor relations. I do think investor relations is really one of the valuable resources a lot of individual investors don't take advantage of. But again, if you want to find the ticker, you can go to our website, in the search box, type in the company name, or vice versa. If you know the ticker but you don't know the company's name, you can just type in the ticker into the search box and you'll see the company name as well.
Yeah, a couple of questions asking, what's the best source for information regarding ROEs, and also how does one find industry data for comparisons?
So on our stock evaluator page, we actually do show comparisons on it. A+ investors have access to more data about companies, how companies are compared to their industry peers. So that's two places you can actually look. For those of you Stock Investor Pro, we have a lot of data in Stock Investor Pro. In fact, you could build your own screens if you want your own. You could actually build your own views. So if you want to do some more analysis and say, I want to look at X, Y, and Z criteria versus the industry, you could actually use our screening program to do that. But I will say on our website, just take advantage of our Stock Evaluator. That's a really good place to see how a company compares to its peers.
And do you prefer reinvesting your dividends or taking the dividend cash and buying different securities?
That's a good question, and I think it does vary. With my 403B plan and really most of my accounts, I do have dividends automatically reinvested. With our dividend investing portfolio, however, we allocate the dividends to cash, and then we actively choose how to reinvest that money. So we wait till the dollar amount gets to be a sizable enough amount of money to reinvest. We do the same thing with VMQ stocks, where the stocks in the portfolio that do pay dividends, we have that money allocate to cash, and then we strategically reinvest it. So I don't know if there's necessarily one that is necessarily better than the other. If you have it go to cash, it certainly gives you more control over how you're going to invest those dividends. But if you automatically reinvest them, then obviously you like the stock, you get to increase your position in the stock. So I think there's advantages and arguments to both.
And one last question before you continue on. When it comes to the free cash flow calculation, is that based upon operating cash or the overall cash flow?
It's based on operating cash flow, and I believe our use of it is operating cash flow minus capital expenditures, CapEx, which is really money used to buy this plant, equipment, machinery.
And also, I think we typically subtract out the dividends as well.
Thanks, John.
Very good. Well, I'll let you continue on, and I'll keep monitoring the questions here for you, Charles.
Sounds good. Yeah, share my screen here. John, I trust everyone can see my screen, correct?
Yes, we can. We can still see your screen.
Great. Okay. Don't want to start talking without people seeing what I was doing. All right. So now I'm going to go into some basic rules for funds and ETFs. So we were talking about stocks earlier. So now if you own mutual funds, you own ETFs, and you can really apply these rules for those of you who own closed-end funds. In terms of buying a fund or an ETF, the big place to start off with is what allocation need are you trying to fill in your portfolio? Are you looking for large cap stocks? Are you looking for international stocks? Are you looking for bond funds? Think about what need in your portfolio you want to pick. That'll immediately will narrow down the universe of funds and ETFs. So we include institutional funds. We have data on our website about 25,000 mutual funds. And ETFs, it's between 2,500 and 3,000 ETFs are traded in U.S. exchanges. So a lot of funds to choose from. So to just start by narrowing it down, think about what's an allocation need I need to look at, what global asset class, and then what category do I want to start looking at. And then once you start looking at funds, start considering things like how does a fund compare against its peers. So you don't necessarily want to look for the best performing fund overall, but you want to look for a fund that's performing better than its peers. And it's really important here to consider apples to apples. So you want to look at a small cap value fund versus other small cap value funds, because a small cap value fund is going to have a different stream of returns than, say, a large cap growth fund. You obviously want low cost, because for every dollar you're paying expenses, or more importantly, for every fraction percentage point you pay, that's money that's going out of your portfolio. Now, the difference between say 4 basis points, which is 0.04%, and 0.6%, relative to the size of your portfolio, it really doesn't make a big difference. But if you look at one fund that has a 0.3% expense ratio, another fund that has a 1% expense ratio, that's a big difference. And over time, that higher expense ratio will be a substantial drag on your investment and on your portfolio value. You also want to make sure you just understand what the fund's doing. Make sure you understand the fund's objective. If you're reading a prospectus or you're looking at the description of the fund, you just keep looking at it, you keep scratching your head, you can't figure out what's going on or how the fund's designed to actually carry out the strategy, it probably means it's not the right fund for you. And if you're working with an advisor and he's trying to pitch an investment product or an idea, and you can't figure out what that strategy is, also means it's not the right investment for you. Now, we do make available our risk indexes, category and total. So category risk is how volatile is the fund or ETF relative to its category peers. Total is how volatile is it to the universe of all mutual funds or the universe of all ETFs. So value of 1 means it's as volatile to its category peers, or if you look at the total risk index, it's average. So values above 1 means it's more volatile. Values below 1 mean it's less volatile. So you want to make sure that level of risk fits within your willingness to deal with volatility. So you can have a fund with great returns, but also higher volatility than its peers. And if this higher volatility makes your stomach churn, that maybe you need to go with a more conservative fund. Now, I recently did a first cut looking at short-term bond funds, and we found some short-term bond funds that had higher levels of risk indexes than those with other short-term bond funds. So some short-term bond funds had higher levels of risk, others had lower levels of risk. So we could tell that by looking at their risk index. And what that tells you when you're looking at a bond fund is the fund manager is generally taking on more risk. They're holding longer dated funds, and they're probably holding funds with lower credit quality. And it's a general rule of thumb, since we're talking about funds here, if you're looking at a bond fund, they're both in the same category, and one fund has a higher yield than the other, it probably means the fund with the higher yield is either holding longer dated funds, taking on more credit risk, or both. Now, if you have an actively managed fund, as a general rule, you want to look for stable management. One thing we have noticed, though, here at AAII is we're starting to see more management by committee, whereas before you had, a stellar fund manager, say like a Bill Miller, for instance, that was overseeing the fund, and now we're tending to see more groups of fund managers. So you might have more turnover, but perhaps there's a committee of managers or a fund manager that works closely with their analysts. So you tend to see less change of manager, or maybe you see a change in the lead manager, but the second person taking over might have been with the fund for several years. So it does require a little bit more digging now than it used to. But you also want to consider asset location. So if you're holding an actively managed fund in a taxable account, you want to take a look at the tax cost ratio, and you want the tax cost ratio to be lower for that category. Otherwise, you will actually get potentially some unwanted tax headaches. So this time of year is a site called Cap Gains Valet, and I'll put this in the show notes. It's a guy that every year he's tracking the capital gains distributions from mutual funds. And the reason why this matters in a taxable account is you could get a distribution where the fund itself has realized capital gains in the fund, doesn't have losses to offset it, and those capital gains get distributed to shareholders. So you could potentially have a fund that has negative returns for the year and you still own capital gains taxes. So you want to take that into consideration. And ideally, if you have a fund that's less tax efficient, put in your Roth IRA or your IRA. The IRS is pretty hands-off in terms of what assets you hold in what account. But as a general rule of thumb, your actively managed funds, your funds with higher levels of turnover, those should go in tax-preferred accounts. Roth IRAs, traditional IRAs, your more tax-efficient funds, say your index funds, your ETFs, those should go in a taxable account. And if you want to investigate funds, we have evaluators for it. So this is the ETF evaluator. Our mutual fund evaluator looks pretty similar. So if you want to investigate a fund, you could do it. So I just happened to pick the Renaissance IPO. And I actually got this from our ETF tools page. This particular fund, as the name describes, invests in IPOs. I'm going off memory here, so don't shoot the messenger if I'm wrong, but I believe they hold companies that have been public for up to 3 years after they completed their IPO. And you can actually use this page to actually evaluate how a fund is. So you'll notice on here, along the bottom row here, you see a lot of A's. What this tells you is this fund has outperformed its category peers over a period of years. But then you notice a category risk index, which is F. So what this tells you is 1.20. So what this tells you is this fund has been more volatile than its category peers. Now, you've been rewarded for that volatility through higher returns. So the volatility, which has been to the upside, which is a good thing, but you do have higher volatility. Now, if you go up mid-page here, you'll also notice a D in orange. It also has a higher expense ratio. So relative to its category average, this fund's more volatile. It also has a higher expense ratio. So there's a trade-off for those higher returns. But you can use this for any ETF, and you can find a similar page for mutual funds. So if you want to get some information about the fund, you can actually call up any fund, any ETF by simply typing either the name or the ticker symbol into the search bar on the top of any page of AAII.com and look at it. Now, say for instance, you want to pair two funds together. If you go to the investing ideas page section on AAII.com, you'll find a mutual fund evaluator, you'll find an ETF evaluator, and it gives you these grades, and allows you to do a side-by-side comparison on 2 or more funds or 2 or more ETFs. So if you're trying to choose between the two, you can actually look at the two together. Now, in terms of selling funds, we talked earlier about what you want to look for if you want to buy them. In terms of selling funds, there's a few things you want to consider. One is keep an eye on the objective, particularly if you're owning an active mutual fund. Keep an eye on perspective and see if there's been a change in objective. See if there's been a change in strategy. Now, if you're holding some ETFs, you may also want to keep an eye on that as well, because sometimes we have seen ETFs actually change their strategy, even change their name. Particularly, we see that more thematic ETFs, where they're trying to chase a particular theme that's current in the news right now. I did see some talk about a COVID-oriented ETF coming out. So these tend to be smaller ETFs, tend to be very specialized, And that's often we start seeing the objective change. But even if you're investing in a factor ETF, you just want to track that. Again, monitor performance against its peers. If it's been beating its peers over a period of time and it stops beating its peers, you want to track it. You may not necessarily want to sell them immediately because it might be a fund that tends to outperform its peers during bull markets, but tends to lag during bear markets. We do provide that data in our ETF guides, our mutual fund guides. But if you start seeing over a period of years when it should be outperforming and it's not, that might mean that something's happened with the fund and it's lost its edge. Obviously, if you see higher expense ratios and you're not being compensated for those higher expense ratios, that would be a sign to reconsider the fund. But again, keep an eye out for a change in the manager. Or if you're using an index-based ETF, you may want to also see if there's been a change in the index it follows. And finally, if you're holding an active account and the fund's not as tax efficient as you thought, after you've done some additional research using the tools on AAII.com, that might be a reason to consider selling it. Now, obviously, consider whether or not you have taxable gains and what the tax implications might be in that scenario as well, because certainly in a taxable account, there's other considerations than just how tax efficient the fund is when it comes time to moving it to another fund. Now, in terms of just finding ideas for AI, finding ideas. So I talked to you today a lot about your buy and sell rules, but say if you want to use your preferences just to find investing ideas. These are some of the tools we have available on our website. Our stock screens, our model shadow stock portfolio. We're talking about factors. The model shadow stock portfolio is actually one of the longest running factor portfolios we know of. John actually runs the portfolio. It applies a small cap value oriented approach. We actually look for the smallest companies. So basically looking at the shadows of Wall Street at companies too small for most professionals to get involved with. And then we're looking for stocks whose valuation ranks in the bottom 10% of all stocks. Our mutual fund guides, our ETF guides, those are now available online. Online, they're actually updated monthly. Our A+ investor gives you access to more tools. We recently made some enhancements to our grade screener. If you haven't tried the A+ investor tools, I do encourage you to try them out. And for those of you who are looking for portfolios to follow, our dividend investing portfolio, it's actually invest in dividend investing stocks, 24 stocks. Our stock superstars actually blends 4 different gurus. So if you like the idea of following gurus, you have access to our screens. Our stock superstars report actually puts it together in a diversified portfolio. Wayne Thorpe oversees that. Finally, our VMQ stocks portfolio, I manage that. This is a value momentum oriented portfolio. And then we overlay quality to get rid of the junkiest stocks. This is a portfolio of 20 stocks. So these are all ideas we have available on AAII.com to help you find investments that might match your preferences. Also, I would encourage you to actually write down your preferences and keep track of why you're holding certain investments. So it's not just a matter of knowing what your preferences are, but to be clear about why you're actually implementing in your portfolio. So this is our portfolio composition and notes. This is one of the worksheets that helps forms our wealth building toolkit. And I populate it here with a hypothetical investor. In this case, the gentleman actually Frank wrote down what his allocations are and what he's going to use to actually track those those investments and what his buy and sell rules are. So you can see on the very top where Frank says he's using the value-oriented screens on AAII.com. He's going to sell them when the value grades turn to F. So he's using our screens. Then he's taking advantage of the A+ investor grades to determine where he's going to sell it. But he's also taking notes of the funds that his wife owns, that he and his wife own, to track those as well. The other thing you could do is take advantage of the My Portfolio tool. So this is a home-built portfolio tool we introduced earlier this year. You can find this near the upper left-hand corner of any page on AAII.com. It allows you to build and track your own portfolio. You'll notice in the green box, I've highlighted My Notes. So if you wanted to keep notes by each investment, you could actually use My Portfolio to put it on there. So perhaps you bought a stock and you said, bought this because business is doing well, with the pandemic going on. Sell the stock if I suddenly stop seeing sales suddenly stop growing. You could jot down that note by your investment so it's always sitting there ready for you to access when it comes time to engage your portfolio. It's one of the many tools that My Portfolio has. If you're not taking advantage of it, I encourage you to do it. You can enter in stocks, you can enter in mutual funds, you can enter in exchange traded funds as well. If you have a cash allocation, you can put that into it. If you have bonds, we cannot track the CUSIP numbers. That's not our data feed, but you can certainly put the value of the bonds in there if you wanted to actually keep that as well, so you can keep an eye of your overall allocation. John, by the way, thank you everyone for showing up. John, are there additional questions I can answer?
Sure, Charles. How much time do you have for tonight? We've got a couple questions here to answer. We'd be more than happy to accommodate them as long as you're available.
I am available.
Okay, very good. So when it comes to holding underperforming assets, how long should you hold them before considering selling them?
So I think it depends really the reason why you bought them. And the question is the investment really violating one of your sell rules? Now, if price is part of your sell rules, then certainly an underperforming asset would be to do it. But if it's a company you bought simply because it's not performing well, but it's not violating of your sell rules, then it requires patience. In the October issue of the AAII Journal, Chris Peterson, one of our contributing editors, wrote a great article about the price of being different, and he showed in a chart in the article about how value strategies underperform for periods of time, but then if you're patient, you're willing to stick with them, you get rewarded for the upside. So again, it really comes down to having clear rules, and is the investment violating a sell rule? And if it's not, then it does require some patience. But again, realize your preference and your personality has to be one who can be patient by waiting.
What are some good ways to analyze analyze founder CEOs and their track record with early growth companies?
Oh, that's a tough one, particularly if the companies have not gone public, you don't have as good record, particularly if they sold on it. I would just, if they've gone public, at least you can look at the companies and look at past performance. The SEC's Edgar database will give you access to old reports, particularly the company's been acquired. But if it's a case where somebody's actually sold off their companies, then it really comes to a case of trying to maybe Google the person, see what you can find on their past companies, see what's happened with them. But keep in mind, you also want to consider, was a founder's past success because they happen to be with the right idea at the right time? Or was it because they're truly, say, an Elon Musk or Steve Jobs, where they truly are visionaries?
I've got a member here, Dilbert, who's noted that it's important to have sell rules, but how do you balance that with the research that shows that excessive trading can be detrimental to your long-term performance?
No, that's a good point. I think it really comes down to thinking through your sell rules and how you're applying your sell rules. And really what Jim Clune said about having that disciplined, well-defined approach. So you really want to, based on academic research, you can look through the journal. We've had several experts over the years contribute their ideas. So you really want to think about, what is the basis for making my decisions? What's the logic behind it? Am I basing it on academic research, on industry research about what's worked over time? Or am I doing it because I'm just trying to jump in and out of stocks? So we do not advocate day trading. There are technical analysis strategies such as Wilma O'Neill, which are higher turnover. But again, even that strategy includes fundamentals. So it really comes down to, what is the basis of your strategy? And is it based on years of research and sound strategy, or are you simply trying to speculate? And then when you come to speculation, that's when you run into some dangers.
I've got a member here who really faces a dilemma sometimes. He'll buy a stock and he'll hold it for a couple of years, and it might have a little bit of information that's kind of keeping it from moving up, or it has perhaps a short-term negative performance period. Any suggestions on having any kind of absolute sell rules? Do you sell if it's down 30% from your purchase or 40%? Any kind of overall rule that maybe you made a mistake in buying the company?
Yeah, I don't think there's logic in it. Actually, when I wrote my book, Better Getting Lucky, I suggested a 20% drop. And there are investors that use that. It really is a rule saying that, you know, if the stock falls by X amount, and a lot of times they'll look at the market. So if the stock drops 30%, but the market's down 20%, then you know it's just bad market conditions. But if you see the stock underperforming by X percent, and there's not a magic number that works, but people do use that rule as just a sign that, you know what, I was just wrong about the stock. And it's okay to use those rules, but you want to make sure they're not too tight so you have excess trading. But there are people do use those rules. You need to see professionals kind of using it as a gut check, just saying, you know, I was wrong. But then you have to make sure that you're comfortable in your preferences. You're okay following those rules, because it might make you sell a rule. But realize that when you have that rule, you might sell it, and earnings might come out the next month. All of a sudden, the stock pops, and you have to be okay with that regret happening, because it does happen. So it does come down to your preferences, but there's case for actually using that, or even looking over a period of years where the stock hasn't outperformed and you've held it for, say, 4 years. I believe David Dreaman actually had a rule like that in his book, A Fundamental Investor, where he only held a stock for a certain period of time, and then if it didn't outperform, he realized that maybe he made a mistake and moved on.
I have a question here regarding allocating asset classes amongst different types of accounts, primarily between, say, tax deferred and taxable accounts. This person is asking about Roth IRAs, but you know, what's the thought process one goes through as far as where do you put different kinds of assets amongst your various asset investment fund types?
Yeah, it really comes down to the tax characteristics. And so it's not so much equities versus fixed income. It really depends what you're holding. So for instance, if you're holding bonds, corporate bonds should be in your Roth IRAs, your traditional IRAs, because their interest is taxable. But I would never put a muni bond in a taxable account because, in a tax preferred account, because the advantage of muni bonds is that their interest actually you get is tax preferential. So you actually get a higher after-tax yield on a muni bond if you hold in a taxable account. So it really comes down to tax characteristics. General rule of thumb, in IRAs, Roth IRAs, I'd be thinking about preferred stocks. I'd be thinking about REITs, real estate investment trusts, corporate bonds, or if I had a stock strategy that had a higher turnover. In a taxable account, I would be thinking about municipal bonds, index stock funds, or stocks are long-term holdings, if they pay dividends. Those are the type of things I would be thinking about. So it's not necessarily just stocks in this account and bonds in this account. You really have to get more granular and think about the types of investments you're holding within those asset categories.
The question here regarding ETF performance data on our website. Is it adjusted for expenses?
It is. We're actually looking at the change in net asset value. So the expenses are actually coming out of that net asset value. So your net asset value, basically what you're owning in the ETF, that's actually being adjusted by the expense ratio.
And it's also true with really open-ended funds as well. Open-ended funds will also have things like 12B1 charges that will be taken out of the operating of the fund, and therefore the NAV will be adjusted. So those are part of the expense ratio, and they reduce the rate of return. Is that correct?
That's absolutely correct.
And if members want to know more about this topic, is there anything in an upcoming journal perhaps that might address some of these questions?
Yeah, in terms of the mutual funds?
Correct.
Yes, absolutely. In February, we'll actually be doing our mutual fund guide, and we're actually right now considering moving our ETF guide to February as well, so you can actually do more of a direct comparison to them.
And I believe also the November issue has a... I'm sorry, what was that?
I think you have an article coming out, don't you, on the subject?
I think in November we have a little how did you know or a informational thing on investing basics on mutual fund costs and where to find information about them and how they impact the NAV and loads and all that kind of information.
Absolutely. See, because I'm always so wowed by what John writes that sometimes it takes me a while to like get back in my mind because I'm floored how great it is.
It's
no, but all seriously, it's a very good article.
That's okay.
No, it's a very good article though, so it's definitely worth reading.
When selling a fund in a taxable account, due to performance or allocation decisions, how important are the capital gains considerations that you might have to pay in selling that fund?
Yeah, the big rule is to never let the tax tail wag the portfolio dog. But certainly, if you're looking at allocation that needs adjustments, taxes are a drag on expenses. So it may be a scenario that you may want to think about, if possible, to spread out the changes maybe over different calendar years if you can, or perhaps you look, are there losses you can use to offset the gains? So it's more of a tax management strategy, but certainly if you need to adjust your allocation, if it's really off whack, there might be situations where, unfortunately, you might be better off making those adjustments, particularly if there's been a change in risk tolerance. But to the extent that you're able to offset with losses elsewhere or spread out the change, certainly try to do so.
Does the ETF Evaluator and Mutual Fund Evaluator cover international funds?
It does. It actually covers all our mutual funds and all our ETFs. So it covers domestic and ETF funds. Oh, sorry, domestic and international funds.
A member here is looking for more information on buying individual bonds. And they're not clear if all bonds can be purchased by a broker like Schwab, only certain bonds. Any thoughts as far as that?
Yeah, so bonds are tough. We did an article, a bond buyer's toolkit. I'll ask Gene to put that in the show notes where it came up to it. There's one site, if they're looking to research information on bonds, there's a site called EMA, E-M-A, that has a lot of bond information on it. But they're looking to actually buy bonds themselves. It may depend on what inventory the broker has. It may be a case of going to a different broker. I personally have never bought individual bonds, so I'm not as well versed on what offerings brokers have in terms of total bond universe. But it may very well be that if you're looking for a bond that's not offered by Schwab, it may simply be a case of what they have available to them. I will point out that if people who are interested in buying treasury bonds, you can go directly to the Treasury Department, treasury.gov, and buy treasury bonds, bills, and notes directly from the government. And I don't believe there's any fee associated with those purchases either.
When it comes to tax loss harvesting, substantial identical is open to interpretation. Is there something that's objective in nature that can be referenced?
It is subjective when it comes to funds. With stocks, the general rule is that you cannot buy stocks or options. So the rule is that the investment cannot be substantially identical. As I said, for stocks, it's pretty clear. You can't sell Microsoft, turn around and buy call options on Microsoft. You could sell Microsoft and say buy Google or buy Intel, be fine. Where you hit that gray area, though, like I said, comes to the funds and ETFs. That's more of a gray area, and right now the IRS really hasn't ruled on it. But they could at some point, there could at some point be a tax court ruling where it gets challenged, and that's where you want to be careful. But beyond stocks and beyond that simple rule, it does start getting a little bit gray, and there's not clear rules I can point people to.
I have a member here who sat in recently on a Julie Jason presentation at a local chapter, and she has a good policy statement part of her presentation. It might be worthwhile taking a look at. Is letting you know that, Charles.
Oh, great. Thank you. And I'll reach out to Julie as well. Appreciate it.
How about a person here is interested in ESG, and any comments as far as screens on a website or recommended resources? And perhaps you could elaborate as to what ESG stands for just in case someone doesn't know.
Yeah, absolutely. So ESG stands for environmental, social, and governance. It's basically values investing. I will point out that there isn't a set definition of what they stand for, and even among investors, for some people, they may be really concerned with environmental measures. For some people, it might be more about gender equality. Certainly, some people who are religious might want a fund that's more aligned with their religious views. So it's grown into this whole big new field of investing, but you can actually use our fund mutual fund screener, which is available to A+ investors. We do have an ESG filter in it. But yeah, I do believe we actually do mark funds as ETFs as ESG oriented on our fund evaluator page as well. I'm not sure if you remember or not, but we did do. We have done some ESG, I believe, a first cut as well that we ran in the journal recently.
Okay, and we're running late on time here, so I'll just go one last question here. Are the investing section and financing section only available to A+ investors? I didn't see them on the snapshot page used in the presentation.
So the financials evaluation, there's tabs that are not available in the stock evaluator. They're not available to just AI members. They're available to A+ members. As an AI member, whether you're basic, you're a life member, you have access to the front page, you have access to the charts. All the enhanced data is part of the A+ investor package.
Thank you, Charles. Great presentation.
Thank you, John.
I just wanted to ask Charles if you could bring up the upcoming webinar slide. That would
Absolutely, I'll
be
do.
fabulous.
Sure, right here.
Sure. So I wanted to thank all of our viewers. Yeah, if you could just, there you go. Perfect. I want to thank all of our viewers tonight. Just a reminder that this presentation was recorded. We will be posting that on AAII's YouTube channel, and you will receive a link to that, as well as a link to some of the resources discussed tonight in your email when it becomes available tomorrow. I wanted to highlight some upcoming webinars. We do broadcast every Wednesday around 7:30 Central. You can register for these upcoming webinars at www.aaii.com/webinars. Next week, our own Wayne Thorpe will be hosting a webinar on making the grade, highlighting the new features of A+ Investor. We've gotten some feedback on that product, and we're improving it by talking about the quality grade stock evaluator, a revised one that Wayne will be talking about that next week. The following week, Derek Hageman, who's also with AAII, he's the head of our AAII dividend investing newsletter and portfolio. I'll be talking about the secrets behind AAII's new dividend grader, a new feature that is coming to that service and our website. Don't miss that on November 11th. And then the week after, on November 18th, I will be rebroadcasting A+ Investor Idea Discovery Made Simple, which is an overview of the A+ Investor Service. So with that, I'd like to thank both Charles and John for their time tonight, as well as you for watching us. That's why we do this. And with that, we wish you good health and good wealth. Thank you, everybody.
Good night. Thank you.
Thank you.